So let me give a egoistic answer to that, and let me give a common man's answer to it. The common man's answer is that, look, in 1991 we were 250 billion dollar GDP. Today, despite all the limitations and fights and constraints, we are $2 trillion GDP. The market cap has also moved in tandem with the GDP movement. Sometimes we become little more than GDP, sometimes we go at little less than GDP, but invariably there is a reasonable amount of correlation vis-a-vis GDP movement and the market cap movement. Now, do you think India will stop at $2 trillion GDP? The world doesn't think so. The finance minister himself mentioned that if we take hard decisions, we'll double our GDP in 5 years. Now, we have never done that in the past, so probably will take 10 years to double, but we will recreate over next 8 to 12 years the entire India which is there today, and all the opportunities which if you have missed in the last 25, 30, 50 years, you have opportunity to capture that in just next 8 to 12 years. The world believes that India will continue to march, and that is why they are investing in us. 25% of our listed market cap is owned by foreigners. It's not a blind money. It has come with its own due diligence. So the common man's answer is that, yes, in the short term things always look challenging, but the mankind has continued to move on, and India also will continue to move on. Now let me give the egoistic answer to this. In the entire history of mutual fund, it is very difficult to find where fund managers have returned money. Between 97 to 2003, me and my peers included, we were running fixed income funds which were delivering better return than most equity funds. It was incredible performance because interest rates came down from 14% to 5%. At around 5.5% level, we all went out to our investors saying that please redeem from our income funds, because now as interest rates move up, you are likely to get lower return or maybe in worst case negative return. Not only myself but all my peers passed this message universally. It resulted into almost 85-90% reduction into our fixed income funds, and over a period of 12 to 18 months we achieved that reduction. We moved people into floating rate funds, we moved people into short-term funds, we moved people into hybrid funds, we moved people into equity funds where they made money. None of us bothered about where we were going to make money. We did that. We did that in 2003, 2004, 2005, and it is unparalleled in entire world's mutual fund history. Nowhere in any part of the world fund managers have given up 85-90% of their AUM, which Indian fund managers did. So please trust our past track record. While there is a risk disclaimer which says that past performance is no guarantee of future performance, but at least in human behavior, do look at our past. We have taken decisions which are for the benefit of investors. Going forward, if we find a scenario where we won't be able to deploy our money in a meaningful manner, we wouldn't hesitate in declaring dividend, in paying back, in telling you that it is time to redeem and move out of equity market like we did it in fixed income market.